Established downtrend ends upon the completion of a large double bottom. A triple bottom forms within the range of the double bottom's upper boundary, in the mid-60s. Now, a long-term uptrend line can be drawn from the last double bottom upswing to the triple bottom to gauge the ongoing uptrend. A steeper short to medium-term trend line can also be drawn from the last triple bottom upswing. Expected resistance entering the 70s at previous highs. This coincides with the break of the short to medium-term uptrend line. It is normal to see the market move sideways in the short to medium term once a clear trend line from a pattern has been broken, such as in this case where the triple bottom reversal begins to flatten in November. Instead of a head and shoulders, the market manages to gradually incline and avoid recontacting the 70 neckline area. Even though there is no volume, the increasing bullish sentiment is quite clear, with consistent green candles steadily closing higher to even form a stable upward channel. A classic bearish spike once the lower boundary of an upward channel is breached. Still watching the lower 77 range closely. Bearish sentiment was building, but like normal, the short-term context with daily candle price action was vital. Even the two large red candles that closed under 77 still stayed over the short-term support with their open and high prices. So there was no decisive break to follow the brief dips under 77. Focusing on short-term candle price action following bullish weakness at the first resistance from 79. After another bounce off the lower 77 range, a clear set of downtrend lines can add more detail in terms of the current time range in mid-August, offering more resistance potential at 79. Two trend lines are drawn for greater detail and can be helpful if there is more volatile price action. Two trend lines can also help with the absence of volume. Here there is a lower trend line closer to the real bodies of candles, and the upper trend line closer to the highs of downswings. Currently, this is doing a good job in detailing upper bearish sentiment, both in terms of the approximate price and time range. The third and most recent downswing results in a rapid bearish acceleration due to the convergence of several factors. These include the downtrend lines crossing the 79 level for extra resistance potential, along with the general evening star price action that forms the downswing. After the recent failure to recover back to 79, it becomes clear the 77.30 to 76.50 range, along with the trend lines, presented strong opposition to the promising upswings. At the same time, it becomes clear there was a head and shoulders reversal. The right shoulder of a head and shoulders is essentially a descending triangle to accelerate the drop that begins from the peak at the head. This example demonstrates it was possible to use features from a chart pattern to analyze a developing downtrend even if the pattern wasn't immediately recognized as a head and shoulders or descending triangle during the formation from June to August. Even strong resistance from a neckline range and downtrend lines is not a 100% guarantee the market will keep falling. This is especially true if bullish sentiment accumulates with 3 methods rising price action. That conveniently displays large bullish spikes before and after the resting phase that unsurprisingly forms around the downtrend lines. The first head and shoulders is a variant with double shoulders, since there are 2 downswings before and after the peak that is the head. The second one is heavily distorted with a steep downward neckline, but still displays price action of higher highs peaking and forming a downtrend on the right side. The third example is flatter and quite symmetrical. It is also smaller, so it is not surprising it holds down the market less. It is also in a range-bound context in the long term, but does reverse a shorter-term uptrend from September to November. The continued influence of price action derived from the first head and shoulders ranges can be seen prior to the break up to the 90s. All head and shoulders here demonstrate how the right shoulder and head can provide useful trend lines for assessing the longevity of the drop after the neckline has been broken. The most incredible trend line goes back to the double and triple bottoms. This trend line remains important, with more recent upswings bouncing directly off it to maintain the climb and the same approximate trajectory. The long-term uptrend line could soon return to the center of attention, as another downtrend begins in the short to medium term. Once again, there are a pair of downtrend lines drawn for greater detail, for more of a downward sloping range of resistance rather than a single narrower trend line. There is one drawn lower to contact closer to the real bodies of candles and the highest closing prices of downswings. Then one drawn higher to contact the absolute highs of each downswing. The upper boundary of a double top provides excellent reference for the most relevant support, now at the 87.75 to 87.30 range. Here are a series of bullish continuations from failed bearish patterns. These include a failed head and shoulders with the element of a failed descending triangle on the right side. Then there is a failed concave triple top. Take note of the slight inclines at the end of the patterns. This is a normal feature of failed bearish patterns. A large range halts the early 2009 recovery and produces the outline of a head and shoulders that eventually fails to produce a steep drop, since the proposed neckline begins to see a gradual and later steepened upward slope from 2012 to 2013. It is certainly a major long-term bullish spike after the stable foundation of an uptrend. Along the way, the 87 range is surpassed. This was the site of several major reversals in the broader range down to 70. These include a smaller inclined head and shoulders, and a slightly declined double top. Call it a channel, wedge, or funnel, it doesn't matter. There is a clear uptrend pressing on major resistance ranges. So strongly, a potential double top and a later triple top have likely been avoided. Clean the chart up with a more recent set of trend lines. In this case, it appears the shallower trend line crossing the lowest portions of recent upswings is more accurate. In any case, the influence of the bullish momentum channeling over the 70 boundary is still in full force. Short-term context also sees the most rapid variation of three methods rising price action, with the three most recent candles. There is indeed an ascending triangle, but bullish momentum immediately diminishes, taking the market back under the 77.30 to 76.50 range. The overall uptrend continues in the long term after a brief downtrend that finds support from the first upswing of the ascending triangle. The first upswing of an ascending triangle is often the second most influential landmark after the flat horizontal resistance range. The 74 to 73 area finishes the outline of a less strict head and shoulders that eventually fails.